you are employed in the UK, there are two ways in which you can benefit from a pension fund. Hi guys, welcome back to my channel. It's so lovely to see you here. My name is Carina. I'm the face behind this channel. I love to help millennials who work in capital cities across the world smashing in their day job and also who have side hustles. I help them navigate life stress-free. I'm so happy you're here today. We will be exploring the very potent topic of mortgages, or whether it's wise to pay off your mortgage and stop investing, for example in stocks and shares. The Bank of England increased interest rate to 4%. The average house in the UK is about £250,000 worth. And if you are on a 2% mortgage, it's most likely that you're paying something around £800 a month. There's over 1.5 million people who will be remortgaging this year, and those people would have to join the bandwagon where it is now, which is at 4% for the Bank of England. So they are most likely going to be looking at remortgaging at 5%. You're very easily going to be paying anywhere between 1,400 and 1,500. That's quite a substantial amount increase from an £800 mortgage a month. And so the question is, do I just stop investing and then just put my money into my mortgage repayment? And investing could be your pension or your stocks and shares. And so I'm going to look at pension today because this is a topic that a lot of us struggle to understand. The average pension in the UK is about 50,000 worth, which really, when you think about it, is not a lot of money. And so I've made a video on pension and I'm going to put that in the detail section so that you can access that video and go back and watch it. I'm also going to link it to this video at the end so that you can also have access to it. Because I know pension is a very difficult topic, and if we follow statistics, they say that a person born today is most likely going to live 150 years. And if we work 35 to 45 years of our life, that's a huge amount of years left to not be working. And if you don't have something in place that is going to support you, you can't really rely on the state pension because that is not a lot of money. And I do agree that things have become really expensive. I am feeling the brunt of it as well. Previously, I used to go food shopping for a week for me and my husband. Now we spend anywhere between 60 to 70 pounds a week. Now that has doubled. I'm spending about 140 pounds on food a week for us. So yes, I agree that the cost of living has tripled in price. Inflation is really affecting everyone right now. So I'm going to go into different types of pensions because I know that's where a lot of people have issues with. They don't understand the pension scheme. The government has passed that responsibility and we have to figure out this thing that we do on how to save our lives and help us when we grow older. It's not very easy, so I'm going to break it down here. If you are employed in the UK, there are two ways in which you can benefit from a pension fund. There's one called the defined contribution scheme. The defined contribution scheme is a pension for employees, and your company can set that up for you once you join and you put money in. Benefit of that is that whatever you put in, you will get out at the end. A lot of times people say to me, oh, I don't want to invest, there's a lot of money. I've really touched on this on my previous video, so please have a look at that video and understand more in detail what the employee type pension is. It's also important for you to actually think about how this pension is invested, because a lot of employee pensions are just invested in low risk investment. And if you're someone who is in your 20s and you're not looking to retire in the next 30 years, why should your money be in a low risk investment? So what I'll suggest you do is to have a look at the pension scheme that your company has. Speak to the HR team. Try to understand how it's broken down. They will send you a breakdown and you can see how your money is invested. I have had employee pensions where I go in and I change the risk tolerance that I want. And so if I'm younger, I would choose the highest risk level because I'm not intending to take the money. So if I lose money in a couple of years, it will bounce back. And so you shouldn't have that much of a fear. And then you start putting money into it. The second type of pension that you could have as an employee is the defined benefit scheme. The defined benefit scheme is really a pension pot for most people who work in the public sector. And basically what this pension pot does for you is that your employee, for a certain period of years, they have to specify that for you. So long as you've done that amount of years, then you will have a guaranteed income. That's one of the best pensions that you could ever have. So if you retired at the age of 65 or 67 or 70, whatever the case may be, and let's say at that age you were earning somewhere about £70,000, so long as you've worked for the company for that a certain period of time which is defined by the company, you will earn that 70,000 until you die, so for your lifetime, which is a really good deal. But you don't see a lot of those now because it's mostly the government that offers that. It's a good incentive to bring in people into the public sector. It's also for those who are self-employed, the type of pension pot that they can also get involved in. It's called the self-invested personal pension, the SIPP. The government have categorized a group of companies that are allowed to offer this type of pension. It's very similar to the defined contribution pension, but this is quite a straightforward way for people who are self-employed that are struggling to find a way to invest in a pension pot. Vanguard is a good example, and so it's quite straightforward. You can choose the amount of years you want to invest, and then you can choose how much exposure you want in terms of risk tolerance, and you can then put a specific amount every month into this, and they would just automatically keep investing it for you. The way SIPPs work is that you pay a management fee. Sometimes this management fee can be quite a lot, so you have to be very careful in terms of the amount that you're paying, because that can really chip into the amount of money you're putting into your pension. And you have to remember that it is for a long period of time, so you can't withdraw it until you've gotten to a certain age. In the UK currently, you can take 25% of your pension at the age of 55, and the balance of your pension you can start taking at the age of retirement. Currently in the UK is 65 for women and 67 for men. And now that I've given you a kind of an overview of how to invest in your pension pot, you might be asking me, but Carina, what happens if I do invest? What should happen with my mortgage? So my advice for anybody thinking to choose their mortgage over their pension, I would suggest that you can do both. You can slightly overpay your mortgage. I know obviously interest rates are quite high now, which means that it's more expensive for you to keep maintaining and paying your mortgage, so you could top up and add more money in there so that you can pay it off sooner. I went into a lot more detail in my other video, which I'll be adding to the detail section. But also what you need to do is that you think about it and you start to put a certain amount into your pension, and then you can also invest in stocks and shares. I know you could look at it and say that, but stocks are not making a lot of money right now, which is true. However, statistically, stocks and shares have made better value of your money over the period of time that you invested. Even in 2008, it was said that statistically the stocks and shares were not going to return very well, but they did exceed expectations. So it's worth hedging your bet and investing in all these three different sections. Put money in your mortgage if you can, put some money in your pension pot, and put some money away into your shares. Diversification is key during this time because you don't know what is going to work out best for you. So it's important to diversify your portfolio. I hope you've enjoyed this video. I've really enjoyed making it for you. Put a comment in the comment section if you do want me to do things differently, if there are topics that you really want me to explore in more detail or probably to share with you. See you in my next video. Take care. Bye.